Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 3rd. My name is Eric Wilkinson, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. Having that out of the way, let's get it on with the economic data. Remember, yesterday we were talking about some of the U.S. and overseas PMI numbers, Purchasing Managers Index. I talked about the one that we really look at is the ISM, which was released today. So let's talk about a couple of those. We had the Institute for Supply Management, the ISM Manufacturing PMI, come in at 54.1, expected to be 57.7, so lower than expected there. Still showing expansion. Anything over 50 is expansion, but it did not meet what analysts expected. That is a miss. Therefore, the overall equities started reacting to that. They're starting to see this slow down here and across the pond, and that, albeit they are above 50, we're just not reaching those expectations, which starts setting back the snowball effect going forward. Then we also got Institute for Supply Management. Prices paid for the manufacturing sector came in at 54.9, expected to be 57.9, so much lower than expected. There are no revisions to the previous numbers, though. And then we got unemployment claims. Tomorrow we get the non-farm payroll, so that's the one to really look at, but this gives us a little bit of a precursor to that. And they came in at 231,000. Jobless claims expected to be 220, so more there, meaning more people coming off the sidelines, basically looking for a job, trying to maybe pay off some of that Christmas debt. So people coming off the discouraged workers, which means they've stopped looking for, they're unemployed, but they haven't filed for unemployment. Therefore, they fall off of this number. Now they're starting to come back into the workforce by filing for or looking for a job, and then therefore filing for unemployment claims when they can't find one. They also revised last month's number up to 221,000 from 216,000. So again, bad revision there. ADP non-farm payroll, though, came in at 271,000, expected to be 179,000. Huge beat on that, as the meaning more, about 100,000 people were employed over than what was expected. They did revise last month's number down from 179,000 to 157,000, so a 21,000 decrease there, but that does not even affect the overall beat today. Even if you take that out, we're still beating it by 70,000 or so. So great number there. And also for the rest of the day, we get total vehicle sales, so keep your eyes out for that. Phil LeBeau from CNBC does a really good job of covering that data point throughout the day. We won't really get that until tomorrow when they finally tabulate everything. All right, on to the overall markets. We've got crude oil moving a little bit lower today after yesterday's big rally. We did get above this Fibonacci 23 Fibonacci extension, or retracement, I should say, but we settled below that. Today we tried again at it and have since started falling back. I think that we'll finish above there and then start migrating back into the mid 50s the rest of the month. And then we look at gold futures. They're going to continue to climb as we see this equity sell-off going on. Dow Jones down big today. Equities across the board are down. This is a flight to safety as money comes into gold. Remember, if we're starting to see a slowdown, this is going to be the safe haven asset for people right now. And that's what's really driving gold higher, up closer to the 1300s. I thought we were going to go back down to around that 1225 area. That's going to be out of the realm of possibility, quite likely, if the equities continue to start showing some weakness. We talked yesterday also about this dead cat bounce in the equities. That's kind of what we're starting to see here. We've got bonds moving higher. Again, global slowdown. Bonds are not going to have higher interest rates. As a matter of fact, it's going to be a signal to the Fed that they need to start pausing or lowering interest rates almost immediately, especially if the overall economies start going into negative territory on some of those economic data points that we've been talking about. VIX is moving higher. It looks like it's a little bit lower today, but we've had some big swings in the equities where they've gone into positive territory and now just really starting to accelerate to the downside, which is bringing the VIX back up. You know, it is a fear indicator as people are buying puts in the equities to cover some of their equities. That drives the VIX higher. Here we're looking at the Dow Jones Industrial Average down over, what is that, 500 points. It was down about 600 points just not too long ago. We're starting to get a little bit of a move here. But yesterday, in the last couple of days, we've been talking about this setup here where it started looking like a continuation pattern to the upside. But the weakness, not being able to get through these Fibonacci areas, has really caused this to start rolling over. And that's that dead cat bounce scenario that I've talked about, where you get this big sell-off, the weak hands come in, start buying it up a little bit too early, and then all of a sudden a resumption to the downside. It hasn't really confirmed that yet, but it's not looking too good, and therefore I'm holding off on adding anything to my portfolio. All I've been doing is looking to take stuff off now. NASDAQ, again, down over 100 plus points, albeit it is off the lows of the day. Again, you know, yesterday we settled above these Fibonacci's. I thought we were going to be doing pretty good. The economic data today is throwing a wet blanket on that scenario, and the market has started rolling over, as you can see here. Over to the E-mini S&Ps, down almost 50 points. They didn't make it up through those Fibonacci's that I was hoping we could get through, and therefore it's created like this little tweezer top here that is very bearish, especially with the confirmation to the downside. It's below the 9-day moving average. All of those things not setting up very well for a bullish move here as of right now, at least with this, if it were to settle right in and around here. So let's take a look at the 30-minute chart of the E-mini S&Ps. Each blue section is a day increment, and each of these candles is a 30-minute. You can see heading into the early morning session, coming into the open of the day, we were near the highs, but then this economic data points that we started getting really threw the wet blanket on the overall markets, and we've sold off to the lows of the day. Bit of a bounce here going on as of right now, but I have a feeling that's really just some day trading short covering going on. All right, a couple of things that I'm looking at with yesterday's rally in Facebook. I was very close to being able to cover this for slightly worse than 50% of max profit. I was squeezing it out for about 65 cents. I think the low it got was about 69 cents, and should have probably pulled the trigger on that. Still holding on to a working order in there for 61 cents. If you remember, I just sold those Jan 128 123 puts in there yesterday for about $1.20, and I was trying to get out of those for 65 cents today. I'm working a 61 cent bid right now, and not really close. It's actually closer to where I got in yesterday right now. And that's it. Like I said, I'm not adding anything right now. I covered that Procter & Gamble and a couple of other things yesterday and the day before. It's actually made my overall portfolio pretty neutral at this point because of the Starbucks negative delta trade. So Starbucks and gold being to the downside has kind of neutralized my portfolio being delta neutral, slightly negative to the negative side, but not really drastic. Any type of trade could really clean that up rather quickly if we started to see it move to the upside. But because we're seeing this weakness, I'm going to leave my portfolio negative delta bias. All right, and that's about it. Webinar later on today is on the poor man's covered put. This dead cat bounce could be a great setup for the poor man's covered put because we've gotten a nice little retracement here. There's a lot of overhead resistance, and we'll be able to play that with this strategy. You're going to be able to use a lot less margin than if you were to go out there and do this with a stock. A lot less headache going on with all the other things that go on with shorting a stock that you don't really incur when you're playing around with these options. And I'll show you how to set that up to increase your probabilities of success today. So go to protraderstrategies.com, sign up for that. I'll take the fear out of this negative delta or shorting the market type of scenario. I'll show you how and why it is a good time to set up with this strategy. Okay, so if you can't take that, take it easy.